In this video, we are discussing the balance sheet. In this video, we're just kind of doing a little bit of an introduction. So first of all, what is the balance sheet used for? How is it useful to us, and does it have limitations? The balance sheet summarizes the economic resources and obligations, basically the assets and the debt that impact the entity's ability to generate future cash flows. It helps us understand the rate of return on its investments. And third, it assesses risk associated with an entity. How does it do that? It provides inputs for cash flow measures. Let's look at what those are. Liquidity is a measure of the nearness to cash. So basically, if you have more liquid assets, you are able to access them when needed and pay off liabilities. Solvency is a measure that's doing long-term ability to pay. Financial flexibility is basically showing the entity's ability to respond to unexpected needs and opportunities. So as we would have it in our own personal budget, do we have a little bit of extra wiggle room so that we can deal with things that happen when it's unexpected or take advantage of new opportunities? There are some limitations on the balance sheet, though. Many of the accounts are recorded using historical cost, not market values or what they would sell for if we had to liquidate. In addition, we have assets and liabilities that are not even recorded on the balance sheet. For example, excellent R&D, research and development, and you're getting close to maybe having a new idea that can go and become a new product. It's not on the balance sheet, not listed as an asset. Finally, a lot of the accounts are based on estimates, and we saw this was an issue with the income statement as well. When we use estimates, it creates a limitation. It just does. The most important part of being able to understand the balance sheet is understanding the classifications that go with it. Under our assets, we have current and non-current assets. And this part is going to be a little bit new, is that under non-current assets, there's 4 major categories. Long-term investments, something we'll talk about in a later chapter. Property, plant, and equipment. There's our land, our equipment, our machinery, and that also includes the contra asset, accumulated depreciation. We have another category that lumps together all of our intangible assets. And in this chapter, we get to learn a little bit more about what those intangibles are and the definitions that go along with them. Other assets is a catch-all for anything that doesn't fall easily into the other categories. For example, a long-term prepaid asset. You can't put it under current assets even though prepaid items often are in current assets. So a long-term prepaid doesn't fit any of the other categories and it would fall under other assets. Under liabilities, we simply have current and non-current liabilities. And under stockholders' equity, we have our contributed capital, which is our common and our preferred stock. We have retained earnings, our AOCI, and if there is a non-controlling interest, it will be listed under stockholders' equity. Understanding whether an asset is current or non-current, and the same for liabilities, we have to look at the operating cycle. So the operating cycle is the time that you can acquire goods. It's cash to cash. So you take your cash, you acquire goods, you sell the goods, you collect the cash. How long does it take? An operating cycle may be 3 days, it may be 18 months. It depends on the nature of the industry, the company, the products. So with McDonald's, you have a very short operating cycle. With anyone that's making large ships or airplanes, that operating cycle is longer than a year. We use the cutoff as a year. If the operating cycle is less than a year, we use a year. And if the operating cycle is longer than a year, we use the operating cycle to determine whether something is current or non-current. By this definition, inventory is always going to be a current asset, regardless of the length of the operating cycle.